Overthinking is the art of creating problems that don't exist. And in finance, overthinking can lead you to taking on no risk at all or far too much, both of which can be devastating. Overthinking is something that we all do, and it's not limited to people with below or above average intelligence. However, smarter people may be more prone to the dangers of overthinking. In 1998, a group of Nobel Prize-winning Harvard graduates did just that and almost broke the entire US economy.
The whole story is really fascinating because if you take John Merriweather, the two Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country. So an incredible amount of intellect in that room. Hundreds and hundreds of millions of dollars of their own money up. Super high intellect, working in a field they knew, and essentially they went broke.
The disastrous fund that almost broke the US economy was ironically called long-term capital management and modeled the predictable prices of government bonds. Their clever strategy was that when the spread on government bonds widened, they made a bet that they would return to normal levels. This proved hugely successful, and from 1994 to 1997, they had unprecedented gains. Then 1 year later, it all went wrong. A Russian financial crisis, among some other things, caused out of the ordinary bond rates, which in turn caused the fund to lose $4.6 billion in 1 year. At the time, this was so devastating that the US Treasury had to step in order to stop a widespread economic crisis. So what happened here? How could a group of Nobel Prize winning economists be so dumb? Did they scam people? Did they make a mistake? Well, no, they made no mistakes with their financial modeling. The issue was they were overthinking. Let me explain. If you watched My Octopus Teacher on Netflix, you'll know that octopi are extremely intelligent. However, try and watch this octopus get a crab out of an open glass jar. Despite the owner repeatedly trying to show the octopus how to get inside the jar, the octopus is so focused on the crab that it doesn't notice. So what can we do? How can we avoid being blindsighted by data and overthinking? There are two answers to this question, and the first is super simple. Once you've poured through the data and you've determined that a stock is good value, go find a big, comfy chair and just think about the big picture. No data, no internet, just imagine the future. Then and only then consider adding this to your portfolio. Now, usually after saying this to people, I get asked one question: how much should I invest? I think the person that came up with the best and simplest solution to this question is the guy that practically discovered the index fund and all-round nice grandpa, John Bogle. Now, this man, John Bogle, identified the benefits of simply buying the 500 largest companies in America and dollar cost averaging into them over purchasing individual funds. And John Bogle could easily be the richest man alive if he put all of his money into the S&P 500, but he doesn't. Watch this interview.
There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers thing. In the long term, the risk is you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money. And those kind of risks are big risks, and they're risks that we can't measure. No, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about.
This is the difference between knowledge and wisdom. In the 1930s, the S&P 500 collapsed 86% in 3 years. Now, knowledge would tell you that this event is extremely unlikely to ever happen again. But wisdom will tell you that no matter what the odds, no matter what the data, no matter how many stats you pour through, it can happen again nonetheless. It can be incredibly frustrating to know that you can't model everything, but at the same time, it can also be quite liberating. Peter Lynch used to say, if you've spent 13 minutes a year on economics, then you've wasted 10 minutes. By the way, Peter Lynch doesn't sound anything like that. You've got to accept that you can't know everything, so don't even try. And the most important thing you need to know to be rich is